Hello, Steve Broussard again, welcoming you to this presentation which will cover capital gains and losses. Following this presentation, I'll also be presenting on the sale of homes. If you should have any questions or comments, please feel free to direct them to me via email at the address provided. Before beginning the presentation, I want to start out by reminding everyone not to try and memorize everything you hear today. Working in the area of capital gains that we'll be talking about will take time to learn. Rely on your fellow counselors for help and guidance whenever needed. If you suspect a return might be difficult, like someone walks in with a 30-page brokerage statement, think about letting a more experienced tax counselor process the return and then check later to see how they did it. If a tax counselor with experience is available to sit with you while you prepare the return, that would be ideal. We're still looking at sources of income, and in this presentation we'll look at two of them: income from the sale of stocks, bonds, and mutual funds, and income from the sale of a home. Please note that while business losses are out of scope for us, a personal loss from the sale of these types of assets is in scope for Tax-Aide. I need to point out that we'll be talking about capital assets in taxable or non-retirement accounts, as opposed to capital assets in traditional IRA and traditional 401k retirement accounts that are not subject to taxation until withdrawals are taken. Income from these types of accounts will be discussed in another presentation. I just mentioned a capital asset. So what is a capital asset? Capital assets, by definition, are significant pieces of property, such as homes, cars, investment properties, stocks, bonds, mutual funds, and even collectibles or art. They can be used for investment purposes or personal purposes. Investment capital assets include stocks, bonds, and mutual funds. Personal capital assets would include a person's home, second home if they have one, and collectibles. I just mentioned a home and second home as being non-investment assets. Please be aware that houseboats, mobile homes, condos, and other places where people live may be claimed as primary homes and second homes. Collectible jewelry, coins, and antique cars are out of scope for us. We're going to discuss how capital assets are taxed. But before doing so, I think it'd be helpful to discuss the overall taxation of income in the U.S. to better understand how that plays into the tax rates for the sale of any capital asset. The United States has a progressive tax system, meaning people with higher taxable incomes pay higher federal income tax rates. As you can see in the chart, the tax rate is different for different levels of income. You can see on the chart how the government has divided how much taxable income a taxpayer owes into chunks, which are known as tax brackets. Being in a tax bracket doesn't mean you pay that federal income tax rate on everything you make. Each bracket gets taxed at a different rate. Except for the lowest tax bracket, no matter which bracket you're in, you won't pay that tax rate on your entire income. Someone with $9,000 of taxable, I want to emphasize the word taxable, income a year would only pay 10% tax on all taxable income. Someone in the 22% tax bracket would pay 10% on income up to $9,950, 12% on taxable dollars, between $9,551 and $40,525, and 22% of any dollars between $40,526 and $86,375. The overall percentage of your taxable income that you pay in taxes is called your effective tax rate. Let's look at a couple of examples that show how this all works. Here are two examples of how taxable income is taxed. In example 1, let's say you're a single filer with $32,000 in taxable income. That puts you in the 12% tax bracket at the top. But do you pay 12% on all $32,000? No. Actually, you pay only 10% on the first $9,950, and then you pay 12% on the rest, up to the top of the 12% tax bracket. In example 1, every dollar above $32,000 up to $40,525 would still be in the 12% tax bracket. Example 2, if you had $50,000 of taxable income, you'd pay 10% on the first chunk of $9,950 and 12% of the chunk of income up to $40,525. And then you pay 22% on the rest because some of your $50,000 of taxable income falls into the 22% tax bracket. The total bill would be about $6,800, about 14% of your taxable income, even though you're in the 22% tax bracket. That 14% is your effective tax rate. So even though a taxpayer might be paying some dollars in the 22% tax bracket as shown in the example, their effective tax rate is less than 22%. You may hear people talking about their marginal tax rate. The marginal tax rate is the amount of additional tax paid for every additional dollar earned as income. The next dollar of taxable income that someone in example 2 earns would be charged at 22%. So a taxpayer in example 2 would say their marginal tax rate is 22%. I went through that discussion of tax rate as a lead-in to the way in which capital gains are taxed. When capital assets are sold, the taxation depends on how long the assets have been owned by the taxpayer. If held 1 year or less, short-term tax rates apply, which means the taxpayer's gain, assuming there is one, will be taxed as ordinary income. If you recall example 2 a few seconds ago, a taxpayer in that situation would add short-term gains to the taxpayer's other income, meaning every additional dollar would be taxed at the taxpayer's top bracket level of 22%. If the amount pushed the taxpayer's income above the 22% tax bracket, which is $86,375, the taxpayer would start paying 24% on every dollar above that amount. Keep that figure of 22% for the taxpayer in example 2 in the back of your mind for a couple of seconds. Long-term capital assets, which are assets sold after being held for more than 1 year, are taxed in a different way. How much the taxpayer is charged in tax is based on how much other taxable income they have. The tax may be zero if the taxpayer's taxable income places her or him in one of the 2 lowest tax brackets. Going back to example 2, where the taxpayer earned $50,000 in taxable income, if the taxpayer sold short-term assets, the taxpayer would be paying 22% on every dollar from that sale. If they held the assets for more than a year, however, the taxpayer would only be subject to 0, 15, or 20%, depending on how much other taxable income they had. By the way, qualified dividends discussed in an earlier presentation are also taxed at this rate, and inherited capital assets like stocks are always considered to be treated as long-term regardless of the date acquired or sold. One last note, you forget this after I say it, but I wanted to mention it. There's something called the net investment income tax, NIT, which adds an additional tax on investment income for very high income taxpayers. In our case, it's married filing jointly over $250,000, but this is out of scope for us. I'll emphasize again, please note that even though the taxpayer in example 2 we've been talking about is paying 15% on every dollar received via the sale of capital assets held more than a year, the taxpayer's short-term gains would all have been taxed at least 22%, representing a savings of at least 7% by holding the assets at least a year. A little story. When Warren Buffett, who is worth just over $95 billion today, I actually checked on this today, he used to talk about his secretary paying a higher tax rate than him. This is what he was talking about. He was stretching the truth just a little, but it's because his actual salary His salary, which is what the long-term capital gains rates are based on if you have no other taxable income, was less than his secretary's making, or at least that's what he claimed. Here's an easy quiz I've even given you the answers to. I'm just using this to ensure that everyone understands long-term means a year plus 1 day. 1 year exactly would still be short-term. So if someone bought stock, let's say, on the 1st of June in 19 and sold it on the 1st of June in 2020, that would still be short-term. If they bought it 6/1 and sold it 6/2 a year later, a year and a day, that would be long-term. In my presentation on wages and tips, I showed the flow of tip tax information moving from one tax form to the next, eventually ending up on a Form 1040. In a similar way, capital gains information flows from Form 8949, which is generated upon capital gains data being entered into TaxSlayer, to Schedule D, and then on to Form 1040 on line 7. Form 8949 details a capital's assets sales transaction information. Schedule D has summaries for short and long-term sales and capital loss carryover, which we'll learn about later in this presentation. All of the calculations and management of the flow of data is handled by the TaxSlayer software. As just mentioned, when data is entered into TaxSlayer to report the sale of a capital gain, a Form 8949 is generated. Part 1 shown here reflects any short-term items sold. Part 2 on the next slide is populated with any long-term items that are reported as being sold. Note the letter A, B, and C boxes. These correspond to items reported on Form 1099-B, which brokerage firms provide to the taxpayers. We'll soon see a 1099-B example. Here is Part 2, which lists long-term transaction capital assets that have been sold by the taxpayer. We'll cover the sale of a home, which is a personal capital asset, in just a little while. First, we're going to explore the information that's needed to properly report the sale of an investment-type capital asset, including stocks, bonds, mutual funds, and exchange-traded funds, and see how to enter the information into TaxSlayer. In order to calculate the capital gain or loss upon the selling of a capital asset, we must have the date of purchase, date of sale, the stock basis, which is the purchase price plus any commissions and fees, and the proceeds from the sale, which is the amount the stock sold for minus any commissions and fees. When commissions and fees have been accounted for, we call the basis the adjusted cost basis, and the proceeds the net proceeds. The cost basis can usually be found on the 1099-B form. If not, the taxpayer needs to provide the information. For cost basis of assets acquired before 2011 for stocks and bonds, and 2012 for mutual funds, they should check with their broker first to see if the broker can provide the information. If they cannot find the cost, they can try to estimate the cost by determining the year they purchased the assets. If they knew they purchased 100 shares of IBM in 2000, they could check the share price of IBM stock on 31 December of that year, or use the price from a date in the middle of the year, and make sure to document how they arrived at the share price in the case that the IRS asks for the rationale used in determining the cost basis. In the worst case, if cost basis cannot be established, then the cost is set at 0. Please note the cost basis for inherited stocks is based on the date of death, not the date the taxpayer received the inherited capital assets. Sale of securities or personal residences received as a gift are in scope only when the taxpayer provides the basis and the date or dates of acquisition. We talked about reinvested dividends the other day. The taxpayer has been taxed on these, and should include any reinvested dividends in the basis cost. Brokerage firms should have been tracking this for the taxpayer. Here's a standalone 1099-B. These are usually incorporated into a brokerage statement. Let's talk a little about brokerage statements. Before starting a return, read the entire brokerage statement. Look for all the tax forms that are included. Have all the pages. Determine who the owner is. Is it the taxpayer, the spouse, or is it jointly owned by the two of them? Note anything you've not seen before. If there's something you haven't seen before and don't know how to handle, consult with a second counselor before starting if you have any questions. And red flags. We've said before, if it's a virtual or cryptocurrency like Bitcoin, the return is out of scope, even if they've just held the cryptocurrency or virtual currency. They didn't have to make any transactions. If they've just owned it, it's still out of scope. Look for sale without cost basis or a sale with no acquisition date. All of those would be red flags. We typically will not see a standalone 1099-B. The taxpayers will most often provide brokerage statements that contain consolidated tax forms, including 1099 INTs, 1099 DIVs, and other forms. You should find a summary page for the 1099-B with details on other pages. Try to keep the pages in order, the brokerage statement, staple them together, paperclip them, be methodical. Do one section at a time, track each section from summary down to detail, and finish each section before going to the next. When finished, look back over the entire document for unentered numbers. We're going to look at a brokerage statement, but first, you will notice that brokers group capital assets into categories that contain letters corresponding to the letters in Form 8949. You note here A, B, C, D, E, F. It's these boxes that we'll be capturing in TaxSlayer. And now, here's a brokerage statement summary page. The end-of-year tax statements provided by brokerage firms will typically have a single page or two that consolidates different tax forms together. This is an example of a consolidated brokerage statement that contains sections for a 1099 DIV in the left corner, up top corner, a 1099 MASC up at the top right, a 1256 contract section, and a 1099B, which we'll focus on. This 1099B is a summary of detailed information that should be found on other pages in the overall brokerage statement. Note the short-term, long-term, and undetermined length of holding for any assets sold. Now let's look at a page that provides details for just the short-term basis reported to the IRS box. This page provided by Fidelity is an example of the details for short-term transactions reported to the IRS in the red box. In this case, shares of the stocks listed were held less than a year before being sold. Gains and losses have been totaled and would be carried to the 1099-B summary form. In a similar way, summary totals for other information being reported on the 1099-B would be totaled and added to the summary. Now, let's look at how this information would be entered into TaxSlayer. Once signed in a TaxSlayer, since we want to report income, choose the Federal Income tab and then choose the Schedule D Form 8949 option. This screen will appear. To report capital gains and loss items, choose the option at the top. This input form will open. Pub 4012, where this picture was obtained, provides directions on how to report information from the boxes found on the Form 1099-B. On the tax layer input form, specify who owned the asset that was sold: taxpayer, spouse, or joint if jointly owned, and a description of the property. Next, enter the date acquired. If there are a number of assets that are in the same category, they don't need to be entered separately. Just click on the alternate option and select various long-term or various short-term, depending on the length of the time the assets were held. Also use this box for inherited items, which are always considered to have been held long-term. Enter date sold, sales price, select the cost basis type, and enter the cost of acquisition. Again, whenever possible, enter category totals and click on the alternate options box. For a purchase date, click the alternate options, then select various short-term or various long-term as appropriate. For sale date, enter 12/31 and the year or the date of any transaction included. Use category totals for the dollar amounts, proceeds, and costs. If you choose various long-term or various short-term to cover the assets sold, make sure to check box M in adjustments for reporting multiple transactions on a single row. The adjustment area is where we'll also check box W, we'll see that in just a bit, if we're reporting a wash sale. We're now going to walk through the entry of information provided in one of the Tax-Aide workbook exercises. That's not the self-study guide, it's a different document, to show how information is entered into tax layer. This is a joint return for the Sahlbergs. As the ownership of the sold assets is both spouses, we select both in the owner box. We need to key in a description in the description box, so let's call it stocks. This is input from multiple short-term stocks sold. So we next want to enter a check in the alternate option box and select various short-term. Now we can enter dates sold as 12/31/2021 if we want, and the sale price. Next, select the cost information type, which is cost basis reported to the IRS, which is highlighted in the slide above, and then enter the cost. Since we chose various short-term to cover the assets sold, we need to check box M in the adjustments area to state that we are reporting multiple transactions on a single row. And we're finished with our data entry. This is the information we just entered for the Sahlberg exercise. The owner was both, description was stocks, date acquired, various short-term, date sold, 12/31/2021, the proceeds, the cost basis type, cost basis reported to the IRS, which is in box A, the cost, and we had an adjustment, M, which meant multiple rows. Okay so far? We completed one entry by entering category totals for short-term cost basis reported to the IRS. But we have more entries to make. How many more entries do we have? Well, we have two more entries. One is D, long-term basis reported to IRS, and the other is E, long-term basis not reported to IRS. So we'll enter both of those. Notice a capital gain transaction has now been created for various short-term for the taxpayer and spouse. That's at the bottom of this slide. If we wanted to enter another, we could have just clicked on the box that says Save and Enter Another before leaving the first data entry input. If we've forgotten signed out, we'd just retrace the steps at the top of the slide and enter another capital gain or loss. Since we're still in tax layer, we could just click on the Add a Capital Gains Transaction, which is highlighted in the red box. Once again, we would enter the data into the boxes in tax layer as shown. Here's the data for our next entry. The owner is still both. Description, stocks. Now it's various long-term because it's box D. Date sold, the proceeds. Cost basis is reported to IRS. The cost, and we had a multi-row date acquired again, which means we go to the adjustment area and select and click on code M. Here's the third entry. This is the box E entry. It's still both stocks, various long-term. The cost basis type now is cost basis not reported to IRS. And again, adjustment code of M. We now have 3 entries that match the categories on the brokerage statement. It's now time for a demonstration, but first, are there any questions or comments? Now that we've completed the demonstration, I wanted to mention briefly 2 important subjects that deal with capital gains: wash sales and loss carryover. A wash sale is in scope if reported in the brokerage statement. Simply enter the proceeds and costs normally, and in the adjustment area, enter the amount of the wash sale and check the W box. A wash sale occurs when there's an artificial loss, meaning someone sells a stock at a loss and then they buy the same stock within 30 days of the sale. Or they buy additional shares and then sell the shares at a loss within 30 days. Here is an example of reporting a wash sale, again for the Sahlbergs. You can see the wash sale loss disallowed of $226.80. Scroll down to the adjustments section, enter rounded up $227. Scroll down and click M. They're reporting multiple transactions on a single row. And scroll down and click W for non-deductible loss from a wash sale. Capital loss carryover. If capital losses are more than capital gains, the taxpayer can claim a capital loss deduction. The allowable capital loss deduction is the lesser of $3,000. It's $1,500 if taxpayer is married and files a separate return, or the taxpayer's total net loss. So it's the lesser of $3,000 or the taxpayer's total net loss. The taxpayers can use their total net loss to reduce their income dollar for dollar up to the $3,000 limit. If taxpayers have a total net loss that's more than the yearly limit on capital loss deductions, they can carry over the unused part to the next year and treat it as if they had incurred it in that next year. If part of the loss is still unused, they can carry it over to later years until it's completely used up. If available, review the prior year tax return for the worksheet computing capital loss carryover available in 2021. Again, this is if it was a 2020 was the prior year. Review that worksheet if you were working on a 2021 return. I thought an example would help. explain. So this is an example from the IRS. Bob and Gloria sold securities in 2021. The sales resulted in a capital loss of $7,000. They had no other capital transactions. Their taxable income was $26,000. On their joint 2021 return, they can deduct $3,000, which is the maximum. The unused part of the loss, meaning $4,000 after you subtract off $3,000 from their total capital loss, can be carried over to 2022. If their capital loss had been $2,000, their capital loss deduction would have been $2,000. They would have had no carryover. One very important point to make. This is where it would be best to make sure to provide a note stating what losses were carried forward from last year and how many are being carried forward to the next year. Always try to provide that information. It may be useful to the next preparer or yourself if you encounter the same taxpayer's return the next year. This is where loss carryover from previous year would be reported. We won't look at it anymore here. Okay, final thoughts for investment capital gains. Number one, we usually don't see broker statements with capital gains until March. So if you are new, you should not see any of these up front. Some of the brokerage statements, depending upon the types of holdings the taxpayers have, we don't see them till late March. Don't start entering any data until you have the whole picture. Understand the nature of the beast you're going to work on. If it's 26 pages, absorb that, look through that, make sure you understand and have an approach. Take your time, be methodical, the whole thing. Ask another counselor if you're not sure how to handle it. And use category data whenever possible. If there are 50 stocks that somebody sold short term, you don't need to key in all 50 stocks. You can just show it as various short term. So use those category data as much as possible. Now we're going to talk about how to treat the sale of a home. Here's a 1099, which reports the proceeds from real estate transactions. This includes the date of closing and gross proceeds paid to the taxpayer. Taxpayers will typically receive a Form 1099-S, which we just saw, upon the sale of a home. Our concern is whether taxpayers who sell a home will be subject to taxes, which is mainly based on whether they qualify for something the IRS calls, quote, exclusion of gain, end quote, upon the sale of a home. If they qualify, a single taxpayer can exclude from taxable income $250,000 in capital gains realized upon the sale of the house. The amount of the exclusion can be $500,000 for a couple. There are two tests that must be met. Please note that only one spouse needs to meet the ownership requirement of test 1, which we'll see in just a second. Again, only one spouse needs to meet the ownership requirement. Note, although taxpayers can claim a loss on the sale of investment capital assets like stocks and bonds, they cannot claim a loss on the sale of a home. These are the two tests a taxpayer or taxpayers, it's joint, must pass to claim the exclusion. Test 1. During the 5-year period ending on the date the taxpayer sold or exchanged their home, they owned it for 2 years or more. That's the ownership requirement. And lived in it as their main home for 2 years or more. That's the use requirement. So, test 2. The taxpayer hasn't excluded gain on the sale or exchange of another main home during the 2-year period ending on the date of the sale or exchange of their home. Now again, I want to point out, for test 1, if it's a couple, only one spouse must meet the ownership requirement if they're claiming the exclusion. Now, the taxpayers don't have to claim, or don't have to report, I should say, the sale of their main home if they qualify and choose to exclude all of their gain and did not receive a Form 1099-S. Death of a spouse. If the taxpayer sells their home within 2 years after their spouse dies and is not remarried as of the sale date, they can count any time their spouse owned the home as time they owned it, and any time when the home was their spouse's residence as time when it was their residence. In addition, the taxpayer may be able to increase their exclusion amount from $250,000 to $500,000 if the taxpayer or their deceased spouse met the requirements for Test 1 and both the taxpayer and the deceased spouse meet the requirement for Test 2. Don't try to memorize that. I just wanted to let you know that death of a spouse, there are specific rules that deal with that. To record, to capture the information on the sale of a home in TaxLayer, this is the main input form. Basic info, date of purchase, purchase price, sale date, sale price. Next, to determine whether the taxpayer or taxpayers pass Test 1 and Test 2 for the exclusion, it asks information about the home. As you can see at the top, how many days in the last 5 years was the home your main home? How many days in the last 5 years did you own your home? How many days since your previous exclusion? It's looking for, have you sold a home in the last 2 years or not? And then how many days in the last 5 years was your spouse's main home? Same thing. Last 5 years did your spouse own your home? How many days since your spouse's previous exclusion? Total days in 5 years is 1,825. I just threw some dates in here so that these people would qualify. Note the box at the bottom. Check here if you qualify for the maximum exclusion or the reduced maximum exclusion. In this case, putting in the days, it's clear that they qualify for it, so I check the box saying that they qualify for the maximum exclusion, which is $500,000 for a couple. So adjustments can be entered into the adjustments input area and the general adjustments input area. There's two different adjustment areas, if you will, inputs. These add to the basis cost of the home. You'll see a demo, and in the demo I'll show you how that works. But again, these would just say if you bought a home for $300,000 and you had $50,000 in adjustments, then the purchase cost of the home that you report would now be $350,000. Again, you would put in the purchase price. The TaxLayer software will add in these adjustments to get to that figure. Sale of an inherited home. The sale of a home received through inheritance or as a gift is out of scope for us unless it's been used as a personal residence by the taxpayer and/or spouse. The taxpayer must provide the cost basis of the residence. Test 1 and 2 then apply to exclude the gain. And sale of a home, main home. What is a main home? So if you own and live in just one home, then that property is your main home. If you own or live in more than one home, then you must apply a, quote, this is what the IRS calls it, facts and circumstances test to determine which property is your main home. While the most important factor is where you spend the most time, other factors include the address listed on your postal service address, your voter registration card, your federal and state tax returns, and your driver's license and/or car registration. And is the home near where you work, where you bank, your residence, or one or more family members, and recreational clubs or religious organizations of which you're a member? So bottom line is, you can't just claim whichever as your main home. There are factors and there's a small test that you must complete in order to determine what is your main home. I was just going to run the demonstration and then ask if there are any questions or comments. But what I'll do is stop here and before running the demonstration, see if anyone has any questions or comments.